look after the UK assets as and when they've been acquired to ensure that they run smoothly on a day-to-day basis.
Very good, very good. And what we're, so obviously, Manchester is quite a topical thing. I mean, at the moment within UK property, it has been for a long time, to be fair. It's a big name these days. And with the launch of a couple of sites that we're working on in Manchester as the RPA group, I thought it would be good to assemble the team, as it were, to talk about the various ins and outs of Manchester property. So, I mean, clearly you can tell by the topics and the way they're phrased, we think buying in Manchester is a good idea. Why Manchester, why now? So hopefully we're going to address a little bit of that today. Going to talk a little bit about the history of it and what we can expect moving forward, as well as look at the rental market and mortgage markets as well. So without further ado, I think, and chaps, please jump in as you see fit, but I think what's really important here, what's quite useful to do here, would be to put the UK property market into context. Over the last 18 months, it's been quite turbulent, I think it's fair to say, in the UK property market. Certainly, if all you ever read was the headlines, you would certainly believe that to be the case. I remember reading a report by the Deputy Governor of the Bank of England, or a comment by him in, I think, December 2022, where he said that prices were going to come off up to 25%. Now, I never believed that for myself, but what has been absolutely fantastic to see is just how resilient the market is. With year-on-year prices, actually now I think the last figure I saw was 0.7% down across the UK over the last 12 months, which, given the scenario around lending, and Paul obviously will come to that in a second in terms of the roller coaster that's been, quite frankly, but how resilient it's been, and the fact that despite these headlines, actually, as we were saying to people 12 months ago, this is not a market in which you need to panic, in which you need to think, God, what's going to happen here? Because there are fundamentals within the market that actually sort of protect you from that investment angle. And now I believe it's the right time to actually consider buying. And one of the reasons for that is to do with rents. And so perhaps at this stage, Phil, I'll scoot through to the next slide. Perhaps we could talk a little bit about what you've seen from a rental perspective over the wider UK, but particularly in Manchester.
Yeah, certainly. I think with the headlines, with the rental sector, it's always been very positive and glowing. And I suppose for ourselves, we would endorse that as well, with total agreement. Probably over the last 12-18 months, we've seen significant rental increases across the UK, whether that be London, Birmingham, Manchester. We are finding that the demand for property is very strong, and perhaps the supply of property has been somewhat limited. Perhaps one for a number of combinations, really sort of being post-COVID. We have noticed a slight shift in, I suppose, tenants' requirements. Often a two-bedroom property now is well suited for someone, perhaps a single or a couple, that require the second bedroom as a work-from-home office for hybrid working. We are also finding, perhaps obviously again, for developments coming to the marketplace, following COVID, construction has sort of slowed that sort of supply of stock down. So we're finding, again, for the needs of more modern accommodation, for perhaps better energy ratings and such like, people are sensitive on currently. That sort of stock.
Can I just ask a question just around that particular point, actually? Because something that we've seen, and actually, just without meaning to skip around too much on these slides, a certain amount of that is inevitable. I think this bit here about the new build nuance. It used to be that new build properties, say 10, 15, 20 years ago, were less popular from a rental perspective because everybody wanted the, you know, the high ceiling Victorian terrace conversion, or, you know, whatever that might be. Bit of character, if you like, as the character sort of properties, as people used to call them. But is it fair to say now that, given that the energy ratings on those are so often so poor, that your electricity bills and so on are therefore quite high, actually new builds are starting to return better rental sort of numbers than these sort of older properties?
Yeah, I mean, here in the UK, you know, as a marketing sort of requirement, we have to now list the energy efficiency of the properties, so it's seen from day one, full transparency. We see a significant shift of people, particularly, you know, looking to perhaps reduce their utilities, perhaps, like you say, in the older properties, whereby the energy costs for the heating and such like are somewhat higher. So yeah, it's something that's very topical, and is something is highly sought after. The new builds, of course, as well, they lean themselves often to perhaps sort of co-working spaces and communal areas, or again, that sort of community, which again is highly sought after.
I mean, on a basic level, if you're having to pay twice as much on your electricity bill than in an older place and you're on a newer place, it means you can't afford to pay as much rent, right? And that's a sort of a very simplistic way of looking at it, but it's an argument in that favor, right?
Yeah, definitely.
I think sort of coming back to the market as a whole, obviously, one thing that we've seen again with inflation, obviously, is that the government has set this target of 2%, or a level of 2% for inflation, and the Bank of England, and coming to you, Paul, on this, the Bank of England over the last sort of 18 months, up until I think August last year, had raised the base rate significantly up until that point. Now, going all the way from I think 0.25 to 5.25, right, over a sort of roughly 12-month period. From your perspective, Paul, in terms of the general outlook over the next 12, 18, 24 months, I mean, is it fair to say that the base rate is expected to come down, that lenders are getting more competitive, and you expect rates to come down? Is that broadly a sort of a reasonable thing to go along with?
Yeah, I think that's a reasonable consideration to make, Richard. I think we can all agree 2023 was a more challenging year in terms of being accustomed to low interest rates for such a long period of time. Interest rates increased quite considerably. However, I'd say from Q4 last year, we started to see sort of a steady decrease in rates across the board from lenders. So I would say on average every week we're seeing now from last year till now a major lender reducing their rates, becoming more competitive, because at the end of the day the lenders do want to lend. In terms of the forecast, we can never obviously guarantee or predict exactly where rates are going to be. However, the outlook is quite positive. I'd say the rates have stabilized considerably. And to add to that, we are also able to use our leverage. We are one of the largest brokers in London. So our head office is actually in London, and we have certain access and certain leverage as a big introducer to lenders to actually get exclusive rates on certain products as well. So I'd say all in all, it's looking a lot more positive than last year. Even in terms of new builds, typically lenders would want sort of higher loan to values, higher stress tests. That's come down considerably as well. So in terms of options, there's plenty of options for people all over the world, whether that be Asia, Africa, UK, and the Middle East.
Yeah. And I think actually, I think actually that's certainly, as you can see on the screen there, that's now translating in terms of actually sort of transactions starting to increase again. Because actually when what people don't like with investment is uncertainty and volatility, right? And so actually, even if the rates are higher and now forecast to come down, what that's translating to is actually, you know, much higher levels of transactions in the market domestically, and certainly from the overseas market. You know, it's picked up absolutely extraordinarily, really, from about October, November last year, and this year has been extraordinarily positive. There's a couple of numbers there on the screen. You know, 20% more sales agreed in January 2024 than the year previous, and that's a, you know, that's not an RPA stat, that's a Knight Frank stat, for the market as a whole. And I think, you know, and again, that little bit at the bottom there about the predictions. So any investing is all about sentiment, right? It's all about, do people believe it, whether it's Bitcoin or property or whatever. And, you know, right now, you know, you can see there in October last year, Knight Frank were predicting a 4% decrease in prices in 2024. At the beginning of this year, they changed that to a 3% increase, which I think comes back to the fact that exactly what you touched on earlier, Phil, is that there is just so little property being built. I actually saw a stat the other day that there are now more handovers of properties at the moment than there are new planning applications coming through. And so what that means is this sort of supply and demand gap is just becoming exacerbated. It's becoming bigger and bigger and bigger. And so I started at the beginning by saying, why Manchester, why now? But actually, I think this works for kind of UK property as a whole. I think there is a real opportunity for overseas buyers at the moment. There's a window at the moment to get involved with the market before it really starts moving. And I think there's little doubt that capital values are going to increase fairly dramatically, probably from the latter part of this year and maybe next year. And we can see that in terms of the, oh, my mouse is, of course, now frozen. There we go. We can see that in terms of the UK market forecasts, which, if you'd looked at these forecasts, these are forecasts from Savills at the beginning of the year, I think about a month ago. If you'd looked at these forecasts, Savills forecasts from summer 2023, these numbers would be dramatically different. And now we're here to talk about Manchester. And the reason we're talking about Manchester is actually because broadly across the board, the Northwest, of which obviously Manchester is the core component, has actually the most significant sort of predicted growth over the next 3, 4, 5 years. So just on to Manchester. I think for those of you, I would imagine, given that people have joined, everyone on this call has joined to talk about Manchester, there's a certain level of, or to hear us talk about Manchester, I should say, there's a certain level of knowledge of it. But I think it's worth just highlighting a couple of key things about why we like it as a business from an investment perspective. But none of this is new. We're not reinventing the wheel here. And that's the way it should be with property. It should be solid and obvious, because these are the markets that will grow over the next 2, 5, 10 years. So it's actually, by global terms, quite a small city, only 550,000 people. But the interesting thing about it is it's the UK's youngest city. 45% of the population are under 35. 100,000 students. Phil, from your perspective, do you get many students in the letting world, or overseas students?
Yeah, I mean, obviously Manchester itself has got, you know, substantial student population, and that's really a mix of UK students and also a lot of international students, whether that be through Asia or the Middle East predominantly. You know, there is substantial student intake obviously each year, and back to sort of supporting that population being a young sort of under 35s. I want to say Manchester's got one of the stats where the most they retain the most students within the city work, which again we see then filter onto the rental market, because they are, you know, finish their studies and their first job or whatever it may be, they come in and they remain in the city.
The general indicator of future wealth of a place is a young, well-educated population, and that's what Manchester has in spades, right?
Yeah.
So Yeah, I mean, you know, and again, on the right-hand side, there are a couple of key things. You know, 85 of the FTSE 100 have offices in Manchester. I mean, it really is outside of London, the sort of the financial centre for the UK. You know, Spinningfields and Deansgate and these sort of places. These are just home to major employers, I should say, who have all moved to Manchester, or moved offices and people to Manchester, because ultimately it's a little bit cheaper for them to run a business there, office space, all that sort of thing, than it is in London. Plus, it gives them access to the rest of the country. So, yeah, it's a really, really interesting market from that perspective. Again, some figures, you know, some figures on the board there. That the big one that we've already kind of mentioned, but specifically to Manchester, they need 170,000 new homes by 2038. I mean, this is a virtually impossible target given planning constraints, given the cost of build, given, you know, the workforce. You know, one of the effects of Brexit, of course, has been that free flow of workers has not been possible, and so therefore it's harder for builders and more expensive for builders to build. So all of this has meant that ultimately, you know, there is this sort of this real lack of supply within the market. It's also worth noting that in 2023, despite the fact that you know, again, if you forgive me for believing all the headlines at the beginning of 2023, you know, everywhere was going to drop off in price. Manchester and Birmingham too have actually held values really, really well. And actually, if you look at average values in central Manchester, they've actually crept up slightly, even in what has probably been the most difficult, most volatile property market that we've seen over the, you know, certainly from my point of view that I can remember, you know, since probably 2009, 10. So all of this is incredibly positive for Manchester as a whole. Paul, from just coming to you for a second, is there, do lenders treat Manchester any differently in any real noticeable way to London, or is it ultimately based on the buyer? And obviously there is the quality of the product as well, of course, as a factor. But, you know, mortgages in Manchester on a high level, you know, how do you see it?
Yeah, so you know, as someone that's actually worked in Manchester myself many years ago now, you know, Manchester's come a long way, and I believe there's still a lot more we'll see from Manchester in terms of major infrastructure projects, you know, sort of the retention of young people. So as a result, that's obviously fed to lenders. 10 years ago, I would say the majority of lenders were happy to look at Manchester as security, and maybe one or two were still a bit cautious. Fast forward now, you know, you've got lenders that will lend to clients all over the world that typically would only focus on London or the home counties in and around that M25 region. You know, they're more than happy to look at Manchester now. So, you know, you've got access to the entire sort of lending market now in Manchester, and there's no, you know, there's no difference in rates or anything like that. So Manchester's pretty much as comfortable for lenders to lend as London is, which is obviously great.
Which again, you know, one of the, just to build on that, one of the questions I sometimes get asked is, you know, should I buy, if I want low risk, should I buy in London over Manchester or over Birmingham, for example? Because I think you put Birmingham into the same category as Manchester, and actually, you know, I think with that, the reality is, if you buy sensibly in Manchester, in Birmingham, in London, in the end, there's very little difference in terms of the level of security, because these are incredibly, as we've seen last year, incredibly resilient markets that actually have even grown slightly in the, you know, in what is possibly the most sort of volatile lending market we've seen over 18 months. And so, you know, that in itself to me suggests that actually from a risk perspective these days, to buy sensibly in central Manchester is going to be, you know, from a risk perspective, and if the banks are viewing it like that, and they do this professionally, ultimately that is this is a great sort of feather in the cap of the two major cities outside of London. Phil, to come back to this slide here, from a brick management point of view, do you, obviously there's some really impressive numbers here on the board. I mean, perhaps you could talk us through sort of what Brick have been doing in Manchester and the rental side of things.
Yeah, I mean, for ourselves, I mean, Manchester is one of our sort of key city hubs. We've obviously made reference to London, Birmingham. Manchester certainly up there with them all. In terms of the rental market, we have noticed considerably rentals have stepped forward over the last 12, 18 months. Just a couple of examples there, actually, on that slide. The property to the left is a city centre development. Again, to give you an idea of sort of rental increases, so the tenants have stayed on, but obviously we've negotiated rental increase there in excess of 15% year on year. Old Trafford, again, is up near the Manchester United Stadium. Again, slightly further out of the city, but again, it just goes to show that the demand for Manchester as a whole, central or slightly further out, remains strong. Again, as an apartment there, rental increase of 19%, and that's just a handful of properties there just out of the portfolio we manage in the city. It's very well connected in regards to the tram system and the links throughout. And generally speaking, as a tenant, they are young professionals that, as I say, we've touched on, work locally or may well work maybe sort of hybrid. They can get access into London if they need to once a week or whatever it be. And it's really going from strength to strength.
How long does it take to rent? I know I remember the stat you've got in Birmingham, but how long is it taking to sort of rent a typical 1-2 bed unit in Manchester?
Yeah, I mean, generally speaking, if we were to, let's say, put the property on the market today, being Thursday, realistically, we would have viewings on the property tomorrow and Saturday. We would really be looking, across the portfolio in an ideal world to actually have a tenant lined up, within that sort of, a 7-day window, to have a suitable tenant with the affordability and the criteria that is met with the landlord.
And I think what's really, from anyone that's thinking about buying UK property at the moment, what's really interesting about this tenant demand and how quickly things are being rented, and to come back to what Paul was talking about a moment ago in terms of the expectation of rates decreasing over the next 12, 18, 24 months, however long that, maybe even shorter periods than that. Sorry, that beep's just put me off. What I was thinking is that all that rent, all that pent up demand. The increase in rents, what it really signifies is a pent up demand for people to buy property. Because we can see here 21.5% forecast increases from Savills over the next 3-4 years. We've got units in Oxford Tower being rented for 15% more than they were 12 months ago. Nobody, if you're a tenant and in a decent job, because you have to be in a decent job to pay £1,200 a month or whatever it might be after tax and so on in the UK, nobody wants to be paying those rental numbers. So actually what it means is that there is this real pent up demand for people that as soon as the rates come down, come down to a level that that people from a buying perspective are comfortable with, and I suspect, this is purely my opinion, Paul, but if you're a local buyer and you can buy something at 3.5%, 4%, that's probably the level where things start to really move again. And I know there are 1 or 2 lenders out there that are sub 4% now on certain deals for domestic buyers. But my point being that as an overseas landlord, as an overseas investor, if you can get into the market now using cash that you have saved you not only can you take advantage of what are sort of record levels of rent, you can also get into the market before the sort of domestic market really comes flooding back in, meaning that because of the lack of supply, prices will rise. So that makes sense. I mean, again, Paul, you know, that given those, what for you, what's that sort of magic number for the domestic market in your experience?
Yeah, so I'd say around in and around 4% for the domestic market we're looking at. You know, obviously there's various factors we take into consideration. You know, so more than happy to kind of have independent fact find to look at people's criteria and salaries and income expenditure, etc. But yeah, there are definitely options for clients, you know, sort of sub 4%. And then the international market, you're looking around 5.5%, you know, on a 5-year/3-year fixed products at the moment. But again, it does kind of depend on independent criteria and residency.
Of course. But as a general principle, I think if you know, as soon as the mass market in the UK can borrow at 4% or a bit below, which will come, you know, it will come back in the relatively near future. That is when we're going to see these tenants flooding back into the market, you know, and that's when we will see the prices increase dramatically. So what we're going to do now is just talk through a couple of examples of sort of the products that we're working on at the moment. Now, what you will notice, and bearing in mind exactly what I've just said, what you'll notice in both of these cases that these are both off-plan products. Now, one of them is 3 years off-plan, Falcon, and the second one, Victoria, that we're going to talk about is 1 year off-plan. But in both cases, again, the theory being that you can get into the market, secure a price point, take advantage of what is still, if you're lucky enough to be dollar-based, a relatively weak pound, and then in theory, get a better price mortgage in 12 months or definitely in 3 years' time. So just as an example of the sort of things that we're interested in. So when we're looking, as from an RPA perspective, when we're looking at what the sort of things that we like our clients to buy, that we would buy ourselves ultimately, that I would buy myself, we're always looking for projects that have a real reason to ultimately outperform the sort of the average over the next few years. Regeneration is one of those overused words in property, I think it's fair to say, but in this case, it's absolutely true and absolutely a key driver in terms of why over the next 5 years we believe Falcon and this sort of wider regeneration site will do exceptionally well. So for those of you that don't know Manchester so well, so broadly speaking, this is the city centre. So you've got Spinningfields and Deansgate down here. You've got Noma, the Northern Quarter over here. This whole site, and you'll see in a second actually, when I zoom in, Manchester Victoria, which is the major train line, the major station that comes in from London, is here. This whole highlighted area is an area called Victoria North. It's the largest regeneration project in the whole of the north of England, certainly the largest in Manchester. It's a joint venture between FEC, Far East Consortium, and Manchester City Council. Well over £1 billion total investment. This is a 15-20 year project that they're sort of a few years into at the moment. And it will hold everything from apartment buildings all the way through to houses and so on at the far end. 15,000 new homes, 40,000 people. You know, the numbers are staggering. But the beauty of it is that because it is so close to Manchester City Centre and kind of everything that you want to be near, it is perfectly located for that sort of, you know, to satisfy the demand that we've been talking about in terms of rentals, in terms of that desire to buy. Just zoomed in a little bit further here. So you've got Manchester Victoria station here. Again, as I say, this whole area is being redeveloped, but we're focused particularly on this location here called Red Bank, and Falcon is basically just here. So less than a 10-minute walk to Manchester Victoria Station, and from Manchester Victoria Station, you can then access essentially everywhere in Manchester, down to Trafford on the tram. You can get to Media City and Salford Quays, or you could, you can get to Spinningfields. To be honest, from here, you could probably walk to Spinningfields in half an hour. Like it's Manchester's not that big. It always surprises me actually when I go to Manchester how small it is when you walk from, spend an afternoon walking around from sort of development to development. So Falcon is this building here. You can get an idea for how significant just this portion of it is. Crown View, and this is a development called Victoria Riverside, which was launched and sold late 2022 throughout 2023, exceptionally successful, which hands over later this year. And then we've got Falcon and 2 further buildings, both of which will come to market at some point in the next probably 6 or 12 months. 189 units. This one is particularly notable for the fact that it's what they've done really cleverly here is that you have access to an extraordinary amount of facilities effectively on site. So they have built an entire building, which you can kind of see here in between the others, called the Clubhouse, within which there's going to be a bar, a restaurant, there's a private dining area, gym, co-working space, residence lounge. And because this is a shared facility between effectively three different buildings, it actually manages to sort of reduce the service charge to a really manageable level. What's particularly interesting about this is that for those people that want a payment plan, if you like, if you're interested in putting some money down now, but you don't necessarily want to get the mortgage now, perhaps you want to accumulate further capital throughout the build, Falcon works perfectly, because this is, as you'll see in a second, a 10% payment now, 10% in 12 months, and the balance in 2027. So for people like myself who have always bought off plan and significantly off plan when in the properties that I've bought, this is something that's from that perspective quite interesting, because it does mean you can get in today at a relatively low level. Again, really, top quality finishes throughout, and really just to spend a second on this slide. So this is where this is the payment terms that I was just discussing there, 29,000. So this is a 2-bed unit at 1-bed unit at £298,500. 10% on exchange. I've just realised that should be 29,850. That's a small typo. Further deposit 12 months later of 10%, and then on completion, assuming 65% LTV. Now, what I would say, and Paul, I know you would hate me to make any rash promises here around mortgages. What I would say is that depending on location, depending on where you are in the world, that loan to value may change. For some of our clients, for example, who are on the call in places like Nigeria, you're probably looking at a little bit less to be safe in terms of your investment plans. However, as a broad number, 65% is, do you feel that's fair?
Yeah. So the reality is, buy to let, you're looking as high as 75% loan to value, but like you've just stated, it really depends on the region you are based. More lenders are sort of opening up. However, to be on the safe side, you want to prepare for that sort of 35% deposit. The reason being as well is there will be better rates when you put a slightly higher deposit as well. So typically lenders that would lend up to 75% will give you a higher rate. And then when you get to around 60% loan to value, they offer a slightly different rate as well. So just to give yourself more options, some lenders won't lend at all beyond 65% loan to value. So, I think it's wise to kind of factor in 65% loan to value. And then if we can get you a higher loan to value, fantastic, but you're prepared for 35% deposit.
Yeah, absolutely. Absolutely. It's always better to be safe rather than sorry, isn't it? With this stuff, budget for a bit more than you need.
Absolutely.
Then you should be gone. But what's interesting with that is that and actually before I go to that, Phil, can I just ask you? I know you haven't particularly looked at this exact floor plan, but a typical one bed in this sort of location, what sort of numbers are we talking about from a rental perspective?
I mean, for the block there, I mean, one of the key things for the rental is the actual amenities that the block offered. So a couple of slides back, when people are working from home, for example, you had co-working space, so they don't have to just always be in their apartment. They have a resident lounge. So again, should they have, they can get out of their apartment. Private dining. So again, if they have friends over, they can book a private dining area, so they have a larger area for them to be able to socialize. So all of that adds to the rentals that we can achieve, and you would imagine achieves that premium. In terms of one bedrooms in and around the sort of the area at the moment, sort of 1,300 per calendar month would be quite a sort of a reasonably safe bet, because of course you've got the gymnasium. There's a whole wealth of other really. One would hope by the time it completes, of course, as we've seen by the rental increases, that should have stepped on forwards even further still.
Yeah, absolutely. And that's one of the potential sort of advantages, obviously, of buying so far off plan. And actually, I'm glad you said 1,300, because those are the rental numbers we've quoted or we've used to generate that 10-year return. So that 10-year return of 113% is based upon a 35% down payment with all your costs included, things like stamp duty and so on. It's including a £1,300 a month rent over the next 10 years, but with 2.5% per annum increase, and using the Savills prediction of 21.2% capital value. So that's over 5 years, and then dropping the capital value increases off between years 6 and 10. So actually, I would be surprised if it wasn't quite significantly higher than that, because we've been deliberately conservative in terms of the numbers we've used to predict the returns. But I don't think, given the risk profile of something like this, that's a really interesting return. The other project which I wanted to talk a little bit about is One Victoria. So another big developer, One Heritage Group, not quite as big as FEC, but still very sizable. 129 units across 2 different buildings. So you've got One Victoria West and One Victoria East. Not quite so much in the way of amenities. It doesn't have the gym, for example, but equally it's then considerably cheaper on the service charge. So there's a little bit of give and take in that. And this one hands over at the beginning of 2025, so Q1 2025. From a location point of view, it's actually quite similar. If I go back to this slide here, you can see Manchester Victoria there. It's literally just next to Manchester Victoria Station. So it will also benefit from the extraordinary sort of ongoing regeneration that is going up here, and Noma and Ancoats and the Northern Course. All of that benefits One Victoria. Again, this is a premium product. Don't get me wrong. It doesn't have the same level of amenities that Falcon does, but in terms of quality and finishing and so on, it will be directly comparable, and arguably actually location, given given what I've just shown you there on the map is actually fairly significantly better, given that you can be door to door down to Salford Quays or Media City or Spinningfields probably 10 minutes quicker than you can from Falcon, given that you are literally on the doorstep of the train station. So it has a roof garden. You know, some units will have balconies, concierge. So yeah, you know, again, a very interesting sort of proposition. One of the reasons why we are offering both of these products to our buyers at the moment is that some people, if you're sitting at home and you're thinking, right, well, I like Manchester, I like Falcon, but I don't want to wait 3 years, then this actually, you know, a year goes incredibly quickly. We're already March, so within 12 months, this will have handed over. So if you've got funds on account that you want to do something with, then perhaps this is a better option than Falcon, for example. And again, this is slightly cheaper. Again, it starts than Falcon. So units here start from 277, as opposed to, in terms of available units at Falcon, we're now talking about 298,000. I think that was the unit I had up on the board there. And again, the numbers are fairly similar in terms of the returns. The one significant difference here is that it is a 15% payment on exchange of contracts and 85% on handover, which, as I say, should be at the beginning of 2025. We've been going a little while now, so conscious of taking everybody's time up. Something I should say is there is a Q&A box at the top of the screen on your browser, and so if you do have questions, please feel free. I see we've had a couple come in, but please feel free to put them in there. Just a quick little bit of background about RPA and how we could help. So the idea behind what we do, we're talking about Manchester today, but it's possible that Manchester might not be right for you. It's possible these projects aren't right for you. What we're here to try and do, whether you're based in, you know, Nigeria or Turkey or South Africa or wherever it might be, the UK even, you know, we're here to essentially provide an advisory strategic service to understand what you're trying to achieve and then find a solution that suits, you know, that problem best for you. So if you're looking for income, we'll try and find you something that supports that. If you're looking simply to preserve capital values and you're not that worried about income, well then maybe we'd look at London if budgets afford it. The point being is that there is not necessarily a one-size-fits-all answer to this, and we're here to understand exactly what you're trying to achieve, to then you know, provide that sort of advice to hopefully mean that you get the right product. So with us, it does start with the due diligence and so on surrounding the property itself. So hopefully, I know we've only had a brief look at them, but hopefully with One Victoria and Falcon, you can see that ultimately, you know, there is a solution there that, you know, could fit. We would then hold your hand throughout the purchasing process all the way through to completion. And it's clearly, we can't do all of it. And whilst we provide a conduit, this is why we have Phil and why we have Paul, to ultimately provide key services along the way. So I'm going to now just ask you, Phil, just to, I know we've talked a little bit about it. There's a couple of slides here just to, I suppose, give everybody just a bit more of a background in terms of what you do.
Yeah, no problems at all. So obviously for ourselves as Brick, we are based obviously here in the UK and do, I suppose, the letting and management of the UK asset that you acquire. Most of the landlords I speak to, their hesitation or query is, you know, who looks after the property for them, particularly if they're non-UK based. And we're here for sort of full peace of mind. We're highly experienced. We manage hundreds of properties up and down the country. We have properties spanning anywhere from the South Coast all the way up to Newcastle and anywhere in between, and have multiple sort of offices across the UK. And we actually do everything in-house. We do not outsource any of the advertising, finding of a tenant, so everything. You know, my team would be very familiar with your property, the feedback on viewings, and for ourselves, we're all about maximising your return, increasing those rentals, ensuring we maintain the highest level of occupancy throughout that tenancy. We're very keen, obviously, to ensure that we manage your property efficiently. So, minimising costs for maintenance and such like. And of course, at the end of the day, we're here to ensure that you're happy with your UK asset, and we would look at run and manage it as if we would our own.
Yeah.
Again, obviously,
one of the questions. Sorry, Phil. Just actually, because it's quite topical. One of the questions we have had is come in is regarding what happens if a tenant stops paying rent, and obviously you've got your rent protection point there. So I thought it might just be worth bringing up at this point.
Yeah, I mean, again, obviously, again about maximising your investment return. We're here to negate as many risks as we can along the way, because we house the tenants of the highest caliber. We ensure they obviously meet the criteria for all the referencing on affordability, employment, credit, financial checks. We can offer a rent protection product, which basically, in short, ensures that your rental income is to be relied upon should worst case scenario happen, i.e. the tenant has a job loss, a marital split, ill health, and there was a void period in rent payment. Our products will ensure that for you as the landlord, you maintain your rental income and you do not experience any financial loss.
Yeah, perfect. And I think that's, I would stress, it's an incredibly rare scenario where there is a tenant stops paying rent because of the work you do at the forefront to make sure they're the right people. I mean, incredibly rare, but it's something that's worth having because it guarantees your income. We've probably touched on most of this. But is there anything you'd like to sort of just highlight?
I suppose just to say, obviously, again, for landlords, it's, the tenants, how long are they in there for? Generally speaking, most of our tenants would be for a 12-month term initially. Over 2/3 of our of the tenants will actually renew. So that means they stay for a second or longer term. So again, it just gives consistency, I suppose, for landlords in regards to A, tenants and B, costs involved. And yeah, as I say, again, obviously for ourselves in respect to, also sort of, I suppose, sort of reviews and such like. I mean, by all means, look us up online. You'll see there the credibility, just for peace of mind that you'll be well looked after.
Well, from my side, we've never had anything but positive feedback, Phil, for your services. So thank you for that.
Excellent.
Paul, just similarly, I've got the first couple of slides of the presentation you sent me. Just I suppose again, just to highlight again your services, because clearly, if you need finance, you're quite an important man in the process.
Yes, no, much appreciated, Richard. So so we've been in operation since 2005. Our head office is actually based in Hammersmith, London. And we have a team of over 90 advisors. Between us, we speak 23 different languages. So recently hired a Turkish-speaking client. So we pretty much cover, most languages, as well as offices in Dubai, Singapore, Hong Kong, Shanghai as well. So we're covered across, the Middle East, Africa as well. So I travel regularly to Africa as well and service the clients in Africa. So we have lots of interesting solutions. We're specialists when it comes to new builds. And yeah, I mean, in terms of our reviews as well, we've had over 1,400 plus 5-star reviews. So service is paramount to us, clearly. And because we are the largest mortgage broker in London, we also from time to time get access to specialist rates that other brokers may not have access to as well. So definitely worth having sort of a conversation with us. Happy to provide, even fact finds and illustrations, even, if you're buying 2 years off plan, and kind of hold your hand and guide you through the process, really.
I can testify to how responsive Paul is. So yeah, it's if you do need that information, then please do reach out. We'd be happy to introduce you to Paul. You know, obviously after this. I did have another slide there, but is there anything particularly you wanted to comment on that? I mean, obviously there's a lot of lenders on there.
Yeah, so, and to be honest, there's a lot more, you know, so I think this just hits home into the value of using a mortgage broker, because, you know, it is very difficult, you know, even if you have a relationship with a bank, we can more than usually get much better rates than you can by approaching one or two banks yourself. So yeah.
I think the key with this, and it's the same whether, you know, whether it's, you know, lettings or mortgages or, you know, property, whatever parts of it, there are so many moving parts within property and property investment, so many different people that through that journey that you have to talk to or deal with, different forms to fill in, all this sort of thing. And actually so much of making it easier is just knowing who to talk to. You know, if you walk in, you know, I was talking to a client of ours in Saudi the other day, just who had walked into the bank. I think he was an HSBC customer, had walked into the bank in somewhere in central London and said, right, I live in Saudi, I'd like to get a mortgage. And the sort of lady apparently looked at him like he had two heads, you know. So it just, you know, it's about knowing who to talk to, and because generally this stuff is possible. If you want leverage, if you want, you know, someone to manage your property, you just need to know who to talk to. And that's kind of my role, my business's role in this, is ultimately to sort of bring all these aspects together whilst finding the right product for you as the investor. I think just in conclusion, really just to round off, because we have been going almost an hour now, so thank you very much for your patience, everybody. I really appreciate you joining us. Ultimately, the UK has been shown to be an incredibly resilient market in difficult times in 2023. I now fully expect, and general sentiment now expects, the sort of that market to start moving, or is already moving, I think it's fair to say, given that prices went up in December and January, in a much more positive fashion, and the sort of the outlook over the next 4 or 5 years is very, very strong. So the key with this, of course, is if you're thinking about buying property, the best time to buy property is 5 years ago, right? Always is. 10 years ago, whatever that might be, whatever that's the exact saying is. I think we're in a window here where if you can do the basics well, make sure that you're talking to the right people and buying the right product in the right locations, which is both not as hard as it sounds, but also harder than it looks in terms of making sure that you are dealing with the right product and the right developers. You will do well over the next 5 years, and I'm pretty sure, you know, just with, for example, with both of these products that we had up on the screen, Falcon and One Victoria, in both cases, the developer is expecting to sell the units for more money, the units that they will hold back for owner occupiers, for people buying to live in, which every developer has to do to satisfy mortgage requirements. They're already, you know, they're expecting to sell these for more money than they're on the market for now. And One Victoria is 10, 11 months away from handover. And the developer believes he'll be selling them for about 4 or 5% more expensive, or more expensively than they are today. Whether that happens or not, there's actually no guarantee, of course. But given what we know about supply, given what we know about, you know, what's going on with mortgage rates, or what's expected to happen with mortgage rates, I think there is a compelling enough opportunity that if you are thinking about doing something in UK property and you've got the funds, don't wait, because I'm pretty sure you'll be paying more for that property in 6, 12 months' time than you are today. The off-plan model, I think, is quite compelling because of the fact that we're expecting interest rates and mortgage lending to be cheaper in 6, 12, 18, 24 months. And clearly, you know, ultimately, with you know, we'd love you to buy through us, but absolutely, but if you did just want to have a, you know, a chat with no obligation and so on, we are here in a purely advisory mode. We'd much rather people make the right, sensible decision than just sort of buying any old thing. Paul, Phil, is there anything you guys would like to add? Any closing words from your side in terms of how you see things going, or your views?
Yeah, if anyone wants to obviously have a chat about the rentals and you know, how forecasted rents and perhaps, you know, help them work out some of their returns, then again, obviously just reach out to Richard, and yeah, happy to have a chat in regards to Manchester and other cities within the UK.
I think it's worth saying as well, Phil, that if you know, if there's anyone on the call that has existing portfolios in any location around the place, that actually you know, you'd be willing to have a conversation with them to see whether you can sort of support and ultimately increase people's returns that they're achieving at the moment, right?
Yeah, definitely. I mean, we take on a lot of current, you know, portfolios or properties that are under management that you know, we look to try and add value to, and yeah, most of our landlords are multiple landlords, so yeah, most certainly happy to have a chat.
Very good. Paul, anything from you just to finish off?
Yes, to co-sign this fantastic webinar. You know, as somebody that's actually worked and lived in Manchester, you know, I can definitely agree, as well as London, of course. You know, it's a great opportunity, great location, great things to come in the future. Similar to Phil as well, we can definitely, you know, have a conversation, you know, even if it's 3 years off plan, we're still happy to have that conversation to make you feel comfortable, you know, regarding your finance options. And also, if you also have existing assets, we can also look at that from a potential refinancing point of view, to use that for capital for you know, future purchases with RPA.
Very good, and indeed not with RPA either. If you know, so you're there as an independent broker, aren't you? So obviously, we'd much rather than being through us. Thank you very much, everybody.